Okay, everyone, welcome to the Toro Bravo Retirement Income Podcast. And we are here at the Los Cedros Ranch in Paladero Canyon. And we just got done riding some horses and enjoying the afternoon. And now we want to talk to you about some things that you can consider in retirement. And today we thought a good topic would be cash flow investing in retirement. So what do we mean, Sabani, when we say cash flow investing?
A lot of people overcomplicate it, but the simplest equation is TR equals I plus G. All that means
TR
equals I plus G.
Total return equals
income plus growth.
Okay. Now, typically, what do most people do in retirement?
They're trying to rely on growth, which unfortunately means they got to make sure the market goes up every year that they're taking out the money. Brian, you've been doing this a long time. Have you ever seen that?
I've been doing this over 27 years. I've been through 2000 to 2003. I've been through 2008 and 9. Those were brutal years.
Yeah.
And when you depend on selling shares for income, and folks, let me explain what we mean by this. A lot of times you go to a financial advisor, he says, let's buy this group of mutual funds, maybe throw a few stocks in there. Okay. Well, to get your income that you need, and let's say you're just doing, they say 4% is safe. So you're pulling out 4%, but think about where that's coming from. It's coming from selling shares.
Yeah.
Now, here's the problem. As long as the shares are going up in price, everything's fine. You're in the gravy. You're happy. Your statement's always up. You took out $10,000. You look at your statement, you're up 20. Everything's fine in those situations. But in finance, there's a thing called sequence of returns risk. And can you talk about that, what that means?
Yeah. Sequence of returns risk just means you get unlucky when you're retiring. A prime example of that is anyone who retired in the early 2000s. Brian, guess what would happen if someone just started taking out 5% a year and it's going up with inflation? How long would their money have lasted? This surprises people.
Well, I think it's 14 years, isn't it?
This guy cheated on the exam. He knew.
He showed me the chart. We've actually done research. When I say we, I had Mr. College over here do it. But yeah, we did research, and if you have some inflation and a 5% withdrawal, you're going to zero.
And what that means, Brian, in harsher words, so it really hits the audience, is if you retire at age 69, you are hoping that you die in your 70s sometime because you run out of money.
Yeah. Now, somebody might say, well, if I look at the last 15 years, that's not going to happen. Well, here's the problem. The last 15 years have been good.
Yeah.
But go the previous 13 years before that. Then you had a no growth market. You know, somebody taking out 4% with no fees, with nothing else. What they have is an account that went down by half by the time the 13-year hit.
Brian, would you mind covering no growth markets a little bit more?
Well, 2000 to 2007, you know, the market ended where it began. And then in 2008 to 2013 was the same situation. So when you add up those two segments, you have 13 years where the market literally didn't grow.
Yeah.
And so if you were taking withdrawals, again, selling shares for income, some of the charts we have show that you're down by 50%. Now, somebody says, okay, but the next to 2013 was a plus 32% year in the S&P 500, and the other years were also very good, so you would have gotten it back. So over 20 years, you would have had the same amount that you started with. The problem is, in 2013, if you started this journey at 65, you're 78. Are you thinking you should stay in the market when you're down 50%?
Who wants to be hyper aggressive? That's why people hire us. They no longer want to be aggressive in retirement.
There's reports out there. There's research that says you will be fine. Take out 4%. Even if you lose half your money, just trust the market. You'll come back. Well, that's hard to do.
Oh, yeah.
That's very hard to do, especially, again, you're 78. You've just been through 2 major crashes. It's hard for you to say, well, it's going to be better this time. You don't know that.
Yeah.
So here's what most people do. They get super conservative. They invest in low yield investments, and where they end up, well, the losses are permanent. They have to take cuts in their income, and now they're living on a lot less.
Mm-hmm.
And I joke sometimes, if your retirement plan is to sit on the couch watching Jeopardy with the lights off, paying bills.
That no one wants that, nor should they. People
No.
deserve better in
Well,
retirement.
you should be golfing as
Mm-hmm.
long as you can. You should be doing the ladies' lunch. You should be giving gifts to your grandchildren. If you're doing traveling, these are all things that should be happening in your retirement. But again, when your retirement depends on the market gyrations, that's pretty scary.
Yeah.
And I can tell you that, again, when you take the financial planning courses that we've taken, they tell you simply cut your income when the bad years come.
I thought that was a really unacceptable outcome because there are a couple of financial authors and professors who talk about this, but long story short, they say what some consider as discretionary spending is not discretionary to clients, which just means all the fun stuff you talked about of going to travel, giving money to grandkids, that's not just optional. It's what people really want and what they deserve in retirement. And I think that's a big point that Wall Street misses.
Yeah. So going back to your TR equals I plus G, so many times people, let's say you're invested in the S&P 500. Okay, there's like a 1% at this point. Historically, it's about a 1.5% dividend. So that's the cash flow that you could get. So if you have $1 million, 1% dividend is $10,000.
Does that sound like enough to live off of?
Well,
surely not.
You're a millionaire. You're living on $10,000 plus Social Security, whatever that is.
Yeah.
And then if you got a pension, that's great too. But you need more of cash flow than that. And see, unfortunately, because people have focused on the G, and the G has been very good, the growth has been there. They maybe are in the Magnificent Seven or the FANG stocks or the high technology companies that are building AI, they're building the internet, all these things. It's like, well, the road goes on forever and the party never ends. And we know that's not true.
Definitely. And in terms of real impact, one thing that blew me away was there was a financial company that did a study basically just asking people, polling them, hey, out of you millionaires in the United States, what percentage of you in retirement don't spend over 100 grand and why? Over half of people were saying that they don't spend over 100 grand. And what was the big reason? They're worried about running out of money.
Yeah. So here, that brings us to, what do we mean by moving from the G to the I? So many have mutual funds or investments that are for growth, but there are investments out there in stocks. They're called dividend stocks, bonds. Of course, we know bonds produce income. There's not a lot of growth in bonds, maybe none at all, but you have this cash flow. And then, of course, there's annuities. Now, we're not here to tell you any of these things are what you should invest in, but what we're saying is, if you have investments that are producing cash flow, what you can do is you can wade through the bad markets, because when the markets start to drop, what's happening to you is you just don't sell the investments and you still collect the checks. Life goes on as normal. Now there are some difficulties, like with dividend stocks. The stock can cut their dividend, the company can go bankrupt. So there's a lot of risks that you need to anticipate and manage for. Diversification is what all the guys like us tell people to do: diversify. So that's one way. But by not focusing so much on the growth, they can make sure that their retirement is going to be there and last. And then furthermore, the last thing I'll say on this cash flow investing, if you have an annuity, you have mortality credits. These mortality credits make sure that you have the income throughout your entire life. So to wrap this up, what we think that retired people should be looking at is income in retirement. Does your investments cash flow? Do they produce income that you can spend in retirement? And is that income reliable? And so I'm assuming that you agree with everything I said, right?
Yes, definitely.
And your phone went off.
Yeah.
But that'll be good for the podcast.
Yeah.
Hey, folks, thanks for listening in. We hope our cash flow discussion helps you. If you want to give us a call, we're Toro Bravo Investment Advisors. You can call us at 806-359-7766. And we'd love to talk to you and help you with your financial planning journey.